You've probably felt that itch, right? The one where you're looking for a way to grow your savings, but everywhere you turn, it seems like the rules have changed. Specifically, we're eyeballing the problem of rising interest rates, which, let's be honest, have thrown bond prices under the bus. Now, there's a pretty neat solution to this, and it's all about investing in dividend stocks. But here's the million-dollar question. With so many options out there, how do you pick the right ones? The ones that are going to be best for your portfolio, offering you a solid handshake of profit without leaving you hanging. Well, that's exactly what I'm going to help you with, and by the end of this video, you will know the best dividend ETFs to invest in. So here are the 7 dividend ETFs you need for passive income in 2024. First up, number 1, the Vanguard International High Dividend Yield ETF, or VYMI for short. VYMI is an attractive option for a few reasons. First, the expense ratio is low, at 0.22%. This means you're not losing much money on fees. Second, VYMI offers a dividend yield of 4.52%. This is how much you're earning in dividends, and it's a decent rate. Since it started in February 2016, VYMI has returned an average of 7.92% per year. These returns are solid, especially considering you're investing for passive income. VYMI invests in over 1,300 companies around the world, which gives you a wide range of investments in one ETF. This diversification is crucial for reducing risk. Most of these companies are in developed markets, making up 80% of the portfolio, with the remaining 20% in emerging markets. Europe and the Pacific region are significant parts of the mix, with Europe making up about 40% and the Pacific about 25%. This ETF gives you a broad exposure to international companies that pay high dividends. It's a straightforward choice if you're looking to diversify your income sources and invest globally. Moving on, the next dividend ETF you should consider is number 2, Invesco S&P 500 High Dividend Low Volatility ETF, or SPHD for short. This fund takes a smart approach by picking from the cream of the crop, the S&P 500 Index. Here's the straightforward scoop on SPHD. First off, SPHD has an expense ratio of 0.30%. This means it's still quite affordable, keeping more of your investment working for you. The dividend yield here is 4.48%, which is pretty close to what we saw with VYMI, offering a solid return on your investment through dividends. Over the last 10 years, SPHD has averaged an annual return of 8.27%, showcasing its consistent performance. The way SPHD works is by selecting 50 securities from the S&P 500, focusing on those with high dividend yields and low volatility. The fund gets a checkup and a shakeup twice a year, in January and July, to make sure it's still on the right track with the best picks. All right, next pick is number 3, the Wisdom Tree U.S. Small Cap Dividend Fund, also called DES. This ETF is focusing on smaller U.S.-based companies that still know how to pay a nice dividend. Here's the lowdown on DES in plain talk. DES comes with an expense ratio of 0.38%. This is a bit higher than what we've seen, but still within reason, especially for the value it offers. The dividend yield here is 2.87%, which might seem lower compared to others, but there's a good story behind it. Over the last 10 years, DES has pulled in an average annual return of 6.35%. It's a steady player, especially when you're looking at the long game. What makes DES interesting is its focus on small-cap, value-oriented stocks, along with core U.S. stocks that pay dividends. These are smaller companies that might not make the headlines every day, but are working hard behind the scenes, often delivering solid value to investors. And historically, these small-cap value stocks have a knack for outperforming the broader U.S. market over the long haul, giving DES a solid chance to boost your portfolio over time. Fourth on the list for 2024 is number 4, FCF International Quality ETF, known as TTAI. This one's similar to VYMI, but with a unique twist. TTAI comes with an expense ratio of 0.59%. Yes, it's a tad higher compared to what we've seen, but there's a good reason for it. The fund aims for the stars, trying to outperform its benchmark, the MSCI ACWI EX USA NR Index, by investing in foreign stocks that aren't just good, they're considered high quality. These are companies with strong free cash flow and sustainable profitability. In short, TTAI picks companies that are not just doing well now, but are set up to succeed in the long run. The dividend yield here is 2.39%. While this might seem modest, it's important to remember that TTAI is playing a different game. It's all about quality and sustainability, which can be a big deal if you're looking for steady, reliable income over time. Since its inception in June 2017, TTAI has managed an average annual return of 5.06%. It's a newer player, but one that's quickly proving its worth. Next up we have number 5, the Invesco High Yield Equity Dividend Achievers, ETF or PEY. This ETF has a pretty clear mission. It zeroes in on the top 50 U.S. dividend stocks with the highest yields that also have a track record of increasing their dividends. It's all about consistency and growth here. The ETF follows the NASDAQ U.S. Broad Dividend Achievers Index, keeping a close eye on companies that are committed to rewarding their shareholders. It rebalances quarterly, and even better, pays out dividends monthly, offering a steady income flow that's pretty appealing if you like seeing regular returns. In terms of what's inside, value stocks are the main players, making up about 3/4 of PEY's portfolio. The rest is a mix of core equities spanning across various capitalization sizes. Utilities take the lead, representing about 25% of the holdings, followed by financial services, which account for about 20%. This composition underscores PEY's focus on sectors known for stability and reliable dividends. PEY's expense ratio sits at 0.52%. It's a bit up there, but the fund has a compelling offer that justifies this cost. With a dividend yield of 4.95%, PEY stands out for providing one of the higher income streams on our list. This is thanks to its strategic choice of investments. Over the last decade, it's averaged an annual return of 10.15%, putting it in a strong position when it comes to long-term gains. Another standout option is number 6, Schwab U.S. Dividend Equity ETF, or SCHD. SCHD follows the Dow Jones U.S. Dividend 100 Index, which focuses on companies that offer sustainable and quality dividends. This means SCHD invests in companies that aren't just paying dividends now, but are expected to keep doing so reliably. It's all about finding those companies that have the strength to continue sharing their profits with investors like you. SCHD stands out for having the lowest expense ratio among our picks, just 0.06%. This is huge because it means you're not spending much to own it, making your investment more efficient. With a dividend yield of 3.40% and a 10-year average annual return of 11.36%, SCHD not only keeps costs low, but also offers solid returns and a reliable income stream. With its low cost, focus on quality dividends, and a broad diversification, SCHD is a compelling choice for investors looking for a straightforward, efficient way to add income-producing stocks to their portfolios. All right, the 7th pick is number 7, Fidelity High Dividend ETF, or FDVV. This ETF offers a smart blend of income and growth potential, focusing on large and mid-cap stocks known for their reliability and growing dividends. FDVV carries an expense ratio of 0.29%, striking a balance between affordability and the value it provides. With a dividend yield of 3.69%, it positions itself as a solid option for investors seeking steady income. Since its inception in September 2016, FDVV has delivered an average annual return of 11.6%, showcasing its ability to generate attractive returns over time. A key aspect of FDVV is its approach to picking stocks. About 90% of its holdings are U.S. stocks, with the remainder spread across Japan, the UK, Italy, Belgium, the Netherlands, and Denmark. This mix not only adds an international flavor to the portfolio for diversification, but also taps into regions known for their dividend-paying stocks. To get your dividend portfolio generating $1,000 a month quickly, I suggest you watch this video next.